I do publish part of my research, so in addition to my consulting work, I publish the Global Finance 360 blog, so I spend a lot of time researching what leading companies are doing. Did want to mention that I have a monthly newsletter, very content-driven. It's not a sales brochure, but it usually has a feature article as well as other posts. So if you're interested, you can always go online and sign up for that, totally free. But I think it's a good resource. Somebody asked me at lunch if I was, and you know the answer by now is, was I a consultant who spoke at conferences, or was I a conference speaker who happened to do consulting on the side? Well, I think by now you've heard that, first and foremost, I'm a consultant, so a lot of the lessons learned have actually been with working with companies who are struggling with these very issues, and what were the lessons learned from those. Okay, so as I said, we have about 5 hours together over the next 2 days. So this first session, the value-adding finance organization, is going to touch on some of the themes we heard today. It's not just about lean thinking, but it's about how can lean thinking really transform your organization from one that simply is the bean counter mentality or whatever pejorative you've heard the operations guys call finance and accounting. And how do you wake up one day and they say, those guys aren't bean counters. Those guys are my value-added business partners. I can't live without them. If they disappeared tomorrow, I couldn't run my organization the same way. And that's ultimately the challenge. So after the break, we're going to talk about the lean assessment. I talk about benchmarking, but there are other things that we need to look at from a, it seems like the volume is fluctuating. I don't know if that's true, but okay. All right. So we're going to take a lean assessment of the finance organization. That's not just benchmarking, but it's also about what's your leadership capacity, what's your program management capacity, what's your capacity to engage in the actual act of becoming a lean finance organization. And then tomorrow we're actually going to talk about what are the steps for re-engineering. And you heard some examples earlier. Again, every company approaches it a little bit differently. I'll give you my take on what it means to re-engineer the corporation and the finance function. What are some of the key steps? What's the framework that you use? And then ultimately, we'll end up with transforming the finance professional and the finance team. What we're going to learn in these sessions is that the nature of finance has been evolving. And we'll talk about that more. But as it evolves, we need to look at the finance professional and what their skills and competencies are and how that fits into the future state vision for your organization. And ultimately, what we need to do is set that vision, understand what our core competencies are now, and then what are those gaps and how do we remediate that, and what are the kind of development interventions that we can apply to the development of the finance professional as well as the finance organization. All right, so I've touched on some of these things. We're going to get into what it means to be efficient, what I've seen in the market, what our perspective from CSC is, and then talk about what are some of the visions, what's the vision for creating a partner organization. And then ultimately, how do you achieve the goals of efficiency and effectiveness? As a finance group, you can make your stakeholders extremely happy. And that may sound like a great thing, and in a way it is. But if you do it at a cost that's unacceptable to the organization, then you still have problems, right? Or you could be a highly efficient organization and pat yourself on the back, but you have a lot of stakeholder complaints because you're not meeting their needs. So ultimately, there's a tension there that we need to figure out when we do our organizational design in terms of how you balance those two requirements. And as I said, we'll talk about what it means to be strategic. So again, if you are not spending your time on transaction processing or an inordinate amount of time on transaction processing, somebody asked the question, well, what are you doing with all your newfound time? Somebody asked Louise. And so that's a great question. What do we do once we create a lean organization? How do we shift those resources to enable business partnership? So here's a quote from Business Finance Magazine, a periodical in the United States. And I thought it was a great quote. I'd like to open up with it. Finance organizations want to be partners. They want to move beyond the controllership mentality, as incredibly important as that still is, right? But there's a challenge. They're not credible with the rest of the organization. Now, I'm not talking about every specific finance organization. I'm talking about finance groups in general. When I speak with senior operations officers, what they typically tell me is, finance, good group of guys, they certainly know their debits from the credits, but they don't really understand our business from an analytical perspective, right? They understand that, this cost went up or this cost went down, but they don't understand the true drivers of cost, right? So there's this credibility gap that finance typically has or can often have with finance organizations. And building that credibility is essential and transforming their own organization. So something to think about as we go through. So this list, I wanted to list some of the top things that I've seen in the market and also that I've uncovered from my research. This list is not exhaustive. Your company may have other priorities, but this is about creating a value-added organization. A little bit later in the deck, we're going to get through, all right, so if this is the vision and this is what we want to free people up to do, how do we go about doing that? So support corporate strategy. I mean, at a very high level, finance needs to be aligned with what the corporate strategy is. We're going to talk about that in subsequent presentations about what does it mean to have a strategy that supports corporate. But fundamentally, whether the corporate strategy is to move into new markets, develop new customers, get into certain industries, offer certain services, finance needs to understand what that strategy is, and they need to create their own strategy that ultimately supports corporate strategy. Maintain profitability and margins. I mentioned this in my opening comments. CFO Magazine does a survey every year, talks about the top CFO concerns. And near the top of the list was the issue of profitability. With the global financial crisis, obviously, for a lot of companies, revenues went down, the cost structure stayed the same to a certain extent. There's erosion of margins, and then the whole issue of liquidity also in terms of managing cash, forecasting cash. These are things that were very much on the minds of CFOs as they were being surveyed by CFO Magazine. Monitor and identify risk, again, something I mentioned. Risk has always been kind of in the background from a finance perspective, but with the failures of Enron and other companies, there was this issue of really understanding risk and identifying it and managing it actively. Something companies haven't done effectively in the past, but that's received a lot more effort now because of what's happened. Regulatory compliance, and again, reporting convergence with IFRS and a lot of regulatory issues. These are things that companies are really struggling with, or at least they're focused on. How do we do this in a way that, again, does it efficiently, but also maintains and improves transparency of financial reporting? And then attract and retain talent. And it's interesting, years ago, obviously, this was a huge, huge issue. The thinking now probably is, well, Steve, we're in a recession, or at least it's flat growth or moderate growth. Is attracting and retaining talent really that big an issue right now for organizations? Interestingly enough, if you read the New Zealand Herald this morning, there was a front page article, at least on the website version, that it was difficult for some companies to attract and retain top performers. So even in a flat or moderately growing economy, long-term talent management is still a very, very critical issue. Now, there's other things that are not up here, things like merger and acquisition analysis, capital structure, funding, capital planning. Those are all key issues also. But I did want to just kind of bring up some of the key things that I'm seeing in the market and also that my research has revealed as being critical. So again, what we're doing here is we're kind of shaping a vision of what the finance organization ought to be. So I mentioned this, the evolving role of finance. So if you look historically what finance has done, and unfortunately this is, I guess, how the bean counter mentality kind of arose, is really, first and foremost, they're managers, right? They have to operate the finance organization, make sure that customer invoices get sent out, that vendor invoices are paid, that the books are recorded and closed, and there's financial reports. Those types of basic operations, as well as being the controller, the steward of the corporate assets. And as we just talked about, risk management has become more and more important. So I see those as really the historical roles of finance and accounting. But nowadays, finance is being asked to do a lot more. They're being asked to really step up to the plate and be value-added business partners with operations and with other stakeholders, both inside and outside the corporation. And so one of the things they need to do is be a strategist. So the CFO, a new role for the CFO, relatively new role, is to work with the CEO and other C-level officers on developing and executing the corporate strategy. And again, that's why it's so important to have that alignment between the corporate strategy and the finance strategy. But the CFO, and other senior level officers are very much part of that mix. And then also a catalyst. Years ago when industries and the economy was more stable, I'm going to make sure I don't block, I realize I'm blocking a little bit, was more stable, it wasn't as much of an issue of being a catalyst because it was pretty much the same thing. Again, industries were stable. But with a global environment, there's a lot more dynamics going on. Finance organizations are really being asked to help drive change in the organization. And that's part of the what's leading up to this whole lean finance thing in terms of how do we drive change both within finance and then how do we assist our partners in business and operations to really continue driving change in their organization. So the question is if the role of finance is evolving, and it is, right? What's the right allocation of time? What should companies be doing? So I cited this in my opening remarks, and this is actually from the American Quality and Productivity Center, and this is a survey that they did. And you can see there, so we've got the 4 categories of transaction processing, control, management, and decision support. So you would think intuitively that leading companies spend less time on basic transaction processing and more on decision support, which, of course, is what the survey revealed. What's interesting is that first quartile companies are basically, in a sense, this composite number, we'll talk more about benchmark data in a moment, but fundamentally, they're twice as efficient as fourth quartile companies. And that's saying a lot. So the question is, and again, this is a mixture of different companies and different industries. How is it that some companies can spend or devote only 30% of their FTEs to transaction processing, while poorly performing companies double it at 60%? Well, we're going to start going through some of those things, and you heard some of those this morning in terms of whether it's an ERP system, it's data management, information reporting, accounts payable processing, all those things play into it. What's also interesting is that fundamentally there's, between first quartile and fourth quartile, there's about only a 5% difference in management. So they're spending about the same amount of time overseeing, guiding, controlling the finance organization. And yet first quartile companies end up being a lot more efficient in the way they actually manage their practices. So before I get on to this slide, I want to just stop and see any comments, any questions at this point. Okay. Again, we're just communicating information at this point, but so this is a busy slide. I'm not going to read through everything on here. The point is that finance organizations are, again, being asked more and more to do a number of things. Clearly, finance strategy, we talked about that. We'll talk about it a little bit more. The whole investors, and not just investors, but creditors, making sure that there's good transparency of financial information. That hasn't always been the case. Again, there's been some issues, and that's why there's been new regulatory requirements and that type of thing. We talked about scarce resources, so it depends on the country. Obviously, the United States is different from New Zealand in many ways, but there is an aging workforce overall. But also the thing is that job requirements are changing. We're going to talk more about that in professional development is how do you align the skills and competencies that are needed by an organization based on what your strategy and your vision is. It's about financing the organization. I mentioned that a little bit in my opening comments about with the global financial crisis and the restriction of capital markets that being able to generate cash from operations is so much more important, but also being able to forecast the sources and uses. We talked about risk management, effective information. This is something that companies struggle with, and I'm always amazed, decades after the ERP revolution, when we were supposed to be able to gather all this information in one central repository and push a button, and everybody got the information they needed. It's amazing how, in many ways, we're further along, but it's also amazing how many times companies are still struggling with this very issue. I have a number of clients right now that, again, made millions of dollars of investments in ERP and other technologies. But what I find happens, and I think you heard this morning, is many times it's not a technology solution. I forget if it was Rick or someone said, technology doesn't fix people problems. And that is so true. So many times when we're talking about managing information properly, we find out that it's really a people problem in terms of they're not safeguarding data, they're not managing a strategic asset, they're breaking the rules if there are any. So there's a lot of issues around that in terms of how do you govern the creation and management of information. Efficient and effective back office, that's really a lot of what we're talking about today with lean finance. How do you create that? How do you do it in a cost-effective manner? And also, how do you maintain it? It's not enough just to create an efficient organization and you've probably been part of this before, is you come up with a great idea, you execute an initiative, everybody's psyched, and then 2 years later, you're back to where you started, right? So there's a whole issue of governance, and how do you maintain that? And of course, profitable performance. So a lot of that, a lot of what we're talking about figures into that. The other key point on that dimension is companies need to have a set of metrics that they manage by. I have clients who, when I ask them, do you have metrics that you manage by, they go, oh yeah, we got tons of metrics, right? And they're absolutely right. They do have tons of metrics, right? So many, in fact, that it's hard to keep track of it. It's hard to actually collect the data accurately and efficiently. And so that's one of the things that leading companies are doing, is really getting a handful of metrics that help drive the strategy and help monitor the strategy. And that's something we can talk about a little bit later. So in our next session after the break, we're going to be talking a lot more about benchmarking. But I wanted to throw up a few numbers for you. So benchmarking can be very powerful, and we'll talk about that later. Okay? But there's also a lot of caveats, right? So when I typically throw up a slide like this for clients, I look out in the audience, and I can see them doing the mental math, right? So I've got a client right now that's about $3 billion in revenue, and they've got about 250 people in their finance organization in a few different countries, Canada, US, Australia, other places. And so they look at that and they say, Steve, are you telling me that we can only have 150 people in our organization? No, I never said that. But Steve, it says 50 people per billion in revenue. Yeah, you're right, it does. Okay. Benchmarking is good to help set direction. It's a data point in a much more comprehensive review. So if you look at these numbers, and I know there's some smaller companies here, maybe some bigger ones too, these numbers typically are a composite of many, many different companies. Some are extremely large, over 150 billion in revenue per year, US dollars, right? So pretty big company. You would naturally expect for them to be much more efficient as a, cost as a percent of revenue, and you'd be right, right? So if you're a smaller company, you don't feel like, oh, we have to get to 0.53% revenue, basically 1/2 of 1%. But here's the power of these types of numbers. If you look at a company that's, say, and I know this is fairly large, but it's a $5 billion company, and they're at an annual cost of, say, 1%, which is about average for companies that I've seen, right? It's not terrible, not spectacularly good, about average, okay? But leading companies can be at 0.5% or more. Some of the very large ones I've seen, I can't tell you who it is, but it's a large global company, actually was less than 0.2% of revenue. Extremely, extremely efficient, but they're a large company. Again, it helps you be directionally correct and helps set what you think ought to be some of the opportunities. Some of the other things around span of control. We look at organizations and see, how flat are they, or how hierarchical are they, and how efficient are they. And you can see that, about 5 to 1 for manager to employees. So again, it's a composite number. In some organizations, maybe in accounts payable, it might be flatter. In other areas that center more around expert services, you might expect a shorter or smaller span of control. Another interesting one, percent of finance transactions automated, around 65%. So again, you think, well, see, that seems pretty low for leading organizations. And again, some are much higher, so this is a composite number. But the revealing thing is that, decades after the ERP revolution, right, there are still companies struggling, and you may have this issue too, with, Steve, we're still doing a lot of Excel. I've got a client who, they swear up and down that the E in ERP stands for Excel in their company. And after having been there for a number of months, I would agree. It is astonishing. They have SAP, all right? So SAP is not a off-brand, second-rate, information system. It's a world-class information system, okay? But you can have a world-class information system and still not use it effectively, right? Which is what we're seeing there. Still a lot of journal uploads. One of the big things I see is a lack of integration between, say, an SAP system and some of the older legacy systems. Typically, there can even be where they extract from one system, they format in Excel, they upload it. Guys, that's not automation, right? Just because you have data between two different systems. So that's one of the things I think impacts that number. And then we talked to monthly accounting close. Now, Louise, I have to tell you, you put me to shame because I think you're closing in 2 days, right? I think it was 2 days. or 3 days, in that range. What we've seen, and again, it depends on the size of the company, but if you look at, and I won't mention a specific company because I can't, but I'll mention a number of companies. If you look at someone like Coca-Cola, ConocoPhillips, DuPont, obviously very large global companies, right? So they do pretty well to close in 5 days or 4 days. And when I say close, I mean all the subsidiary books are closed, report results to corporate, there's consolidation, currency translation, intercompany eliminations, and then the production of basic income statement and balance sheet. Maybe a cash flow statement, but not necessarily, right, at that point in time. That's what we mean by close. So what we've seen in the market is, 5 days, 4 days. Some companies do it a little bit more efficiently. There was a press a while back before business intelligence matured in its technology where there was a move to get down to a virtual close, do it in 1 day. They're doing a lot of things like doing the accruals before month end, all reasonable practices. But I think what we've seen is they've backed off that a little bit in terms of how important it is to close in 3 days versus 5, because now they're much better at managing information throughout the month, right? Not just financial information, but even better is operational information that helps them predict what's going to happen. It helps them forecast better throughout the month. And because there's been the rise of that level of maturity in the BI systems, and also the emphasis within organizations on treating information and data as strategic assets, I think there's been a little bit of pressure backing off on this. But 5 days is still a good number. Again, some organizations clearly do it more quickly than that. So I have to ask, do these numbers surprise you anyway? Are they about what you would expect? Okay, withhold judgment. All right, fair enough. Okay, so what prevents companies from achieving world-class performance? We've seen a vision of what the finance organization as a value-adding organization can be. And we've seen some numbers around what constitutes leading performance. Again, if your company's smaller and you're not there, that's okay. We need to look at what works for you as an organization. I mentioned the issue of disparate technology. So what happens is I touched on the fact that you can have these legacy systems in an ERP like SAP, and there's still a lot of manual intervention. Anytime you get humans involved, you basically raise the cost of the process, you slow it down, and you make it more prone to human error by definition. What's also interesting is a lot of companies have the same type of software like SAP, but they have different instances of those versions. They have, maybe they acquired a company, and one of the companies is either behind them in the version or actually ahead of them, right? So you have this issue of compatibility, even within a single vendor like SAP. Again, poor business intelligence architecture, that was the whole issue of how do you collect data, both financial and operational, and put it in one place. Again, I can't tell you, even to this day, how many clients I have where they say, Steve, we have a management reporting problem. It's really, well, what kind of problem do you have? Well, John from operations shows up, and he's got one set of reports, and Bill from finance shows up, and then the VP of development shows up, and they all have different numbers. It's like, well, where do they get the information? Oh, well, they've got their database, and they've got theirs. Well, of course you've got a management reporting problem, right? So the nirvana of how do we get one version of the truth is something that eludes even the largest global companies. It's still amazing at this point. Again, it's not a technology problem. Technology can solve that. It's a people problem because of governance. When people are allowed to choose what data they want to bring into meetings to represent their results, that's the result you're going to get. So that's one of the big challenges to a barrier to world-class performance. Poor data quality. Now, when I think about data, I think about both master data and then operational data. So master data is that static data, chart of accounts, cost centers, inventory items, anything the item master, those types of things. And of course, then there's the actual data itself, the quality of data. So what happens in a lot of organizations is there's not good controls. If in fact there's very little control over data quality. So they spend a lot of time on the back end. When I was in control in private industry and also an accounting manager, it drove me crazy when our group would spend weekends fixing problems that groups upstream had actually created, right? It didn't seem right that they were out playing golf while we accountants were in the office on weekends. And I can see that some of you relate to that. So when you look at what leading organizations are doing, they place a lot of emphasis on getting it right the first time upstream. But there's also an accountability loop. So whenever there's an error loop, right? It doesn't go to accounting to fix somebody else's problems. Many times it goes back so that it's fixed in the source systems, and then it feeds through again. You find that when people have to spend their Saturdays fixing data instead of the accounting group, somehow they miraculously get it right the first time. So it's kind of interesting how that works out. But this is a huge issue, and it really is, again, it's a policy and governance perspective, because unless you make people accountable, then you're going to have problems with quality. The other issue is that IT does not own data. The business owns data, right? So if the business says, oh, well, we'd have better quality data, but those IT systems just don't do something right? Don't go there, right? The business owns the data, and they're responsible. One of the things that leading companies are doing is actually going through and creating these governance councils that actually protect data, manage it, define it, and really help control it. Talked about disparate processes. So, in a large organization, you might actually have people from different business units who think that they're doing a process the same as everyone else, when in fact they don't. So I'm amused is probably not the right word, but when I run a workshop and I've got representatives from different SBUs, these are all finance people, right? And so you'd ask them, well, let's talk about your current state close process, right? And business unit A says, oh, this is how it's done here at the XYZ company. And then the B business unit says, well, that's not right. This is how it's done at our company. And then everyone else chimes in. You find out that even among finance people, they don't have a common understanding of what those processes are. So the issue about disparate processes is very real. And then the delivery model, again, varies by SBU. A lot of hidden FTEs. So this is one of the challenges of lean finance when we think about it is, it's not enough to say you're taking processes out of the business units and centralizing them in shared services. I'm sure we'll hear a lot more about that tomorrow. You have to make sure that people aren't replicating those, or else you end up just adding costs, not actually reducing cost. So the next series of slides, it really just expands a little bit on what we just talked about. And I won't necessarily, so you can see the non-aligned data structures. That has a lot to do with master data. You can have issues where there's multiple charts of accounts. They might not even line up in terms of what is travel expense. It's one account, and it's another account in a different one. And then we talked about the manual data formatting. So here's some opportunities that we've seen with leading organizations. So instance consolidation, right? So if your company has acquired other companies, it has disparate information systems, not just merging onto, say, SAP, but actually getting on the same instance. So basically, instance is you have the same database. You're drawing from the same item master. You're drawing from the same set of vendors or employees, right? There's not a mismatch. This is a huge area that companies have done. Some of the companies I've seen that are global companies that close in a couple days have committed to and have achieved a single instance of, say, SAP that enables them to have this type of efficiency and leanness that a lot of companies would only dream of. And then point solutions. So even a software like SAP or Oracle, or if you use another one, it may be a great package, but it can't do everything well. So typically there'll be point solutions, whether it's a Hyperion, of course that's been acquired by Oracle, but Hyperion was always a good example for many years. But you still need tight integration between, say, the chart of accounts, any group accounts, and that whole thing. So you need to have better integration. And the internal controls. This is another area. I've seen a lot of companies, because they don't have good control over processes, it's hard to be efficient because they have a lot of detective controls on the back end. Fundamentally, somebody prints out a report, looks down, says, oh, this is wrong, let's go back and fix it, right? Where leading companies are actually using this technology to leverage preventative controls up front so that they don't have to have human intervention on the back end, which is really the enemy of efficiency. And it's something, recent development, and I'm sure you've read about this, about cloud-based infrastructures and applications to drive virtualization. So if you look at workforces that are global, and some of you may be in multiple countries, one of the challenges, again, there can often be separate instances of a program. It's hard to get people on the same version. So I think this is an exciting development around cloud technologies to basically virtualize kind of the applications and the ability for disparate workforces, whether in New Zealand, Australia, India, in Europe, or wherever, to actually be reaching out, common data set, common sets of processes, and that type of thing. So I think it's an exciting development. Any comments on technology? So we talked about data and process governance. This is a word you hear a lot, especially at the enterprise level. We've heard a lot about corporate governance. Again, something like Enron, where there was really poor governance from the board of directors, from the director of internal audit, from the internal audit group, whatever. But there's also governance at the departmental level. And one of the things that the finance group can have a key role in is helping to establish, as part of a governance council, what those data standards are. Typically, either they don't exist in any real form, or they do exist, but there's not good controls. So unless you reward people and align their performance evaluations with how they behave or supposed to behave, then you're still going to have a problem. Again, technology can't solve people problems. And then data information is not treated as a strategic asset. The leading companies that I've seen, they really believe in the power of information. A lot of companies say they do. Oh, we've got a BI environment. We've got good management reporting. But you can tell the companies that really focus on creating information and data that's a strategic asset. And they treat it as such, and they devote resources to managing it. So here are the opportunities. Engaging kind of a cross-functional group of people and representatives to create a governance structure. Governance really takes many forms. It can be governance over organizational constructs like a shared service organization, very critical. It can be around data, operational and master data maintenance. We've talked about that. It can be processes, so you've got process councils. So one of the things we've seen with leading organizations is, again, it's a lot of these things that companies say they do, but the leading organizations are the ones who really make it real, is this effective integration of end-to-end processes from procurement to accounts payable. There's a much better, and I want to use the word collusion in a positive way here. These companies get together, they collaborate, they make sure that the processes are integrated. In fact, leading companies many times will appoint an owner of a process like procure to pay. So he or she actually has the authority to get these people together and work out these issues through these process councils to ensure great efficiency. And then we talked about set up master data standards. I know I've hit on that a lot, but it's just astonishing when companies do that well, right? They have so much less heartache, so much less corrections and effort at month end and at quarter end and year end as they're trying to close the books. And data quality is much better. Go ahead.
That's one area that was always a mess before we were trying to do data. It's almost better to scrap it and start again.
In terms of yeah, it is, and that's a very real issue that companies have to deal with, is do we start over? So basically, there's a greenfield. So I've got a client right now who's dealing with that very issue, is it so bad, is our master data structure so bad that we just need to start over? So there's a company I'm working with. They implemented SAP about 17 years ago, and they were in it's a utility. So they were in a retail environment selling to households, right? Highly regulated. And their business model over the 17 years has changed. Today, they're in a wholesale market. It's very much an unregulated market in many of the areas that they operate in. So their master data structure. So we're going through this issue right now. We're holding a series of workshops with bringing key stakeholders from around the organization to talk about this issue is how far off are you from where you want to be? So let's define what the requirements are, and then let's see if your existing master data structure works, right? Or if we need a greenfield implementation, right? So we're far enough into the process now that we're leaning towards, we really should just start over, right? It's more work, no doubt about it. And there's going to be, because you have this data comparability issue between years, right? But you think about it, they haven't done anything in 17 years, right? Except complain about how bad the system is now that they've changed from a retail regulated market to a wholesale unregulated market. Okay, but complaining is not good enough for leading organizations. So we're working with them to make that decision. But you're right. And it's a big decision because there's a lot of work around it. Any other comments or observations?
Key things also around maintenance and alignment for that. That is, especially when you have a lot of business change.
Yeah.
Trying to
Yes, the data comparability.
You don't need to be slowly submigrating the master data if you don't know how you actually doing those changes, unless it's well structured.
Yeah. Yeah, okay, very good. I appreciate that comment. Anyone else? Okay. Complexity management. And we heard this earlier from Louise's case study is, one of my favorite quotes is from Peter Drucker when he said, there's nothing so useless as doing efficiently that which should not be done at all, right? So part of transformation is not just figuring out how to do the wrong things better and faster and cheaper. It's about thinking about what do we not need to do anymore, right? So I think one of the examples cited was materiality levels. I still see this today. Again, decades later after I've gotten into the business, we still have issues around, we want to analyze every variance we have. Really? Every variance, every month at the management committee level? Is that really what you want? Well, maybe not. Okay, good answer. So that's one of the things we need to think about is, how much work can we eliminate? I have another client that, again, about $3 billion, has about 1,800 management reports, right? This is the one that has plenty of operating metrics, too. They have too many, right? So 1,800 reports. Well, how do you get 1,800 reports? Well, very little governance. People write whatever report they want. So the issue, again, is managing information as a strategic asset, identifying what are the things that you want to measure as a company that really make a difference in how you make decisions and how you operate and how you compete. So we talked about, eliminating controls. I was sharing a story at lunch about one of my clients was a state government in the United States. And we went in there and, being the good consultants that we were, we looked at the operations. We said, you can do all these things to reduce complexity, reduce these redundant controls, reduce your cost, life will be great. And they're like, well, why would we want to do that? And it kind of shocked me because I'm not sure I'd ever had anyone ask me that question. Well, it turns out because they're a state government, they're less concerned about saving taxpayers' money and more concerned about being on the front page of the newspaper because they screwed up. And so that's one of those things that you have to really think about what the goals are. In their case, they didn't want to reduce controls, but for most organizations, it's actually a good thing, not to the point where you raise risk significantly. But again, if you can eliminate manual detective controls and replace them with preventive controls, it's better control, lowers enterprise risk, it's more efficient, right? So those are the types of things that leading organizations are looking at. Overly complex chart of accounts for management reporting. So I'm of the belief, and I've seen this in a number of organizations, that the chart of accounts should fundamentally be about regulatory and statutory reporting. So, your SEC reports, your IFRS, your local tax compliance, transfer pricing, those types of things, and that you get a rich and robust management information system through a business warehouse to do that. But what happens is, and this we're going to talk later about who's your customer, right? When we talk about Six Sigma and defining who your customer is, here's a challenge I see, is when it comes to the chart of accounts, everybody's the customer, right? Clearly, regulatory and statutory agencies are. But what happens is you get, again, governance issue. You get a lot of people who come in and say, I need a new account segment. I need a new account. I need new cost centers. I need whatever, right? And you do that for 5 years or for long enough, and all of a sudden you have an overly complex situation. So what happens then, really? Typically, data quality goes down because now people have too many choices, right? Big believer in keeping choices to a minimum for people. But too many choices, they end up coding it to the wrong place. There's a lot of, again, accountants working on Saturdays. Big issue for me because I didn't like working on Saturdays as an accountant, right? But you get that issue where there's a lot of work on the back end, again, because of poor governance up front. So reducing the chart of accounts. Make it as slim as possible so it satisfies regulatory and statutory reporting. Get your basic financial statements out of there if you like. But fundamentally, anything beyond that really should come out of the business intelligence system. That was the second point. Simplify yet strengthen the internal control structure. It gets back to what I was talking about eliminating, or not eliminating, but reducing the manual detective controls on the back end and moving the controls up front, leveraged by technology. And then establish clear management requirements to operations, stakeholders, and focus performance goals on those requirements. Again, it's just about governing, eliminating complexity. Many times you'll get requests from stakeholder groups, like operations, that says, we must have a new cost center, we must have a new account, we must increase the complexity within the financial systems. And then when you talk to them and find out, well, what do you really need? And you find, well, you don't need a new account. You just need to direct it to this account or whatever. So getting behind the needs, working with the operations group and other stakeholders can go a long way towards simplifying the process and eliminating complexity. Process enablement. Okay. So we talked about the fact that many processes will be decentralized. So we'll talk about it more tomorrow. But one of the things we've seen in leading organizations is this idea of centralizing a lot of the back office processes. I know it can be controversial. Culturally, some companies don't like it. The business units like to have control over their own destiny. But the reality is that when you can take basic transaction processing, whether it's customer invoicing, cash applications, invoicing, even management reporting, right, and centralize those, you're going to gain economies of scale. You have pools of knowledge in one place that can leverage each other. So there's a lot of good things that occur around there. So establish corporate standards around, these are the processes that are going to happen at the business unit. Here's what's going to happen in corporate. Here's what's going to happen in a shared service center, right? And then enforce those standards. I have a client, in fact, we're going to see a case study in one of the subsequent presentations that's in the defense area. And they had some like 17 business units. They call them value centers. And fundamentally, they were not leveraging their shared services organization effectively. And so I said, well, so what processes are in shared services? That's when I first got there. I said, well, it depends on which business unit you're talking about. And I said, well, how does that work? And they said, well, each business unit gets to decide if they want to be in it at all, or if they do, what processes they want to throw in. Well, of course you're not going to gain efficiency because you weren't enforcing a corporate standard. So have you, in the back there, does that, I guess that resonates, or have you seen that in other organizations, that there's not a top-down edict for governance in terms of mandating usage of shared service centers? Any observations or comments on that? A farcical situation? It's interesting you'd use that word because in a way I agree with you, but when you think about these are global companies with millions, if not billions of dollars in shareholder equity, right? And you get this kind of behavior. Again, I've been doing this for over 15 years now, and I'm always surprised, right? Because the money, and we did a benchmarking, and we're going to talk about that again. It's a disguised case study. But we're going to talk about that in terms of the money that they were leaving on the table because they let the value centers decide if they were going to use shared services or not. So process enablement, reduce manual intervention, focus on materiality, we've talked about that, and leverage technology integration. And then global service delivery. I've got some slides in another presentation, but it depends on your company. I know some of you are strictly New Zealand-based. It may not make sense to think of a global perspective. But all I would say is this, is you're thinking about your company, but also your careers as you continue on, is globalization is a very real and present issue. And we need to be thinking about what's the right delivery structure, both onshore and offshore. Leading companies have saved a lot. I know it's politically sensitive, and that's an issue. But leading companies have really created leanness in their organization and reduced their cost structure, and in many ways improved service delivery, right, by looking offshore. And there's a lot of markets that are available right now. Yes. Yeah, so let's differentiate quickly. So offshore can be within your own organization. So there are global companies that actually have shared service, they're captive shared service organizations, but they're offshore. They might be in India, they might be in Manila, they could be in Eastern Europe, right, in lower cost centers. But they're not third parties because they're still part of the organization. So third party would be a true, when we think of outsourcing, remember, an outsourcer can be in the building next to you right here in New Zealand, or they could be in Mumbai, right? But that's what I mean by third party integration is, companies need to look at what makes sense for them to have internally. Do we have the critical mass? Do we have the capabilities? Do we have the technology? Do we have the knowledge, right, for these processes? Or do we want to develop them, right? Or does it just make sense to shift them off? I'll tell you this, as part of the global financial crisis, the pressure on margins, a lot of organizations, basically the CEO told the CFO, I need you to cut expenses, I need you to do it fast, right, to maintain margins or at least to prevent substantial deterioration of margins. And so they were looking at the outsourcing solution. So what's interesting is you had companies like UBS, the Swiss banking giant, who actually sold off their entire back office operations to, I believe it was Capgemini. And so what happened is you had this, during the GFC, you had this confluence of events where a lot of companies, not a lot, but some wanted to free up capital and focus on their core competencies instead of back office processes. And you had third-party outsourcers at the exact same time who were looking to take advantage of the situation to build up their domain knowledge in certain areas like financial services or commercial banking or capital markets or whatever. So there's been a lot of maturity in the third-party outsourcing market in terms of their actual domain knowledge around specific issues like insurance or capital markets again. And so it's very interesting. So it's a very viable option these days. So really just to sum up here, we talked about common technology, the fact that the strong data governance can do miracles for data quality, for the amount of time and cost and effort and pain that goes into closing the books, issuing financial reports, processing invoices, whatever. We talked about reducing complexity by having good governance over the chart of accounts, focusing on regulatory and statutory reporting. And then standard processes, so eliminate variation. So really, variation in processes is the enemy of efficiency and of leanness. So as you're thinking about a lean organization, you want to think about how can we standardize these processes. You'll get pushback. I'm telling you that right now. Be prepared for resistance. Why? Oh, because we're different. We must have a different process, right? That was one of the reasons for those 17 value centers I was talking about earlier that they chose not to opt in. Oh, we're different. We process vendor invoices differently, right? It can't be standardized. Don't believe it, right? There's a lot of opportunity in those areas. And then we talked about the model. There's some pure plays, whether it's onshore, offshore, captive, shared services. There's some blended models. CSC is actually involved, and I can say this because it's public knowledge. NASA, the aerospace community within the United States, we actually worked with them to build a shared service center and operate it. So they own the physical facility. They have some of their employees in there as if it's a captive center, but we have some of our employees as CSC working side by side with them in some other areas where they didn't want to build the competencies or capacity to do those things. So there are blended models like that that are working pretty effectively. And then ultimately it comes down to, if you look at what high-performing companies are doing, it's a very delicate balancing act between the people, the competencies and skills, the organizational structure, as well as the technology, how they're leveraging it, how it's integrated, and then the processes themselves. So when you look at high performance, the cost, the value, the service levels, and we'll talk about that as part of shared services in terms of how you deliver services to your customers, where your customers are your internal people. And then all that's predicated on this idea that you're managing information as a strategic asset. And thinking about data versus intelligence, interesting point is it's not enough to have raw data. It needs to be contextual. You need to understand how does that compare to what other organizations are doing externally. This is where benchmarking comes into play. How does it compare to our forecasts, to our budgets, to our goals? Providing context around data moves it beyond data to make it true intelligence, and that's what leading organizations are doing. Okay, so what I'd like you to do is I put some cards on your tables early this morning. And this is a simple exercise. Everyone's going to pass, okay? It's a pop quiz, but you can't fail this one. So don't worry. Don't break out in a sweat. What I'd like you to do is you've seen some of the challenges that organizations face and some of the answers that leading organizations are developing. On your card, I'd like you to write down just two things, right? One is, what's your greatest finance challenge that you're facing today in your organization? And then two, what's the greatest barrier that's preventing you from achieving your goals of that challenge? What I'm going to do is you can just put them in the center of the tables. At the break, I'll grab them and look at them. So I'd like to know so that I can help kind of shape the conversation over the next day and a half. But what I also want you to do is think about this as we get into the assessment of the organization, as we think about re-engineering the finance function, as we think about transforming the finance professional and the finance function. How can those issues help you solve your challenge in overcoming that for your greatest finance need? So that'll be the goal. I'll give you a couple minutes. So we talked about a lot of this. I kind of mentioned up front, what's the vision? How do we create a strategic organization? I mean, ultimately, each of you in your company will have to go through and decide, what is it that creates value in our company? How do we compete? How do we go to market? How does a finance organization enable that, right? But what I can tell you is that these are a lot of the things that leading companies are focusing on in terms of partnering with the business, managing that risk level. And that's a huge issue that I think finance organizations can add a lot of value in risk management. It's something that's been overlooked in previous years, and we've seen the result of some of that. Liquidity is, again, just a huge issue. It ties into capital planning in terms of, especially if you're in a capital-intensive industry, some of my clients are in chemical or utilities, and that's one of the things that they're really struggling with is how do we tie our technical plans and our asset plans with our overall planning function, right? And how do we do it in a way that is efficient and doesn't take half the year? You know, it's amazing. You go into these companies, it's like, well, how long does your planning function take? Oh, about 10 months. So, well, there's only 12 months in a year, and you're telling me it takes 10 months, right? Well, it doesn't take 10 months of full-time work, but it's one of these things that just drags on. It's not focused. There's not a lot of clarity around it, that type of thing. So it's one of the things that organizations can do is with the whole planning function and forecasting is really to help make that more crisp, make it more valuable. Acquisitions, due diligence. You know, most acquisitions don't, and there's various statistics depending on which survey you read, that these acquisitions don't bring the value that was anticipated as part of the business case. And one of the things that the finance organizations can do is really help to understand what the value is and the potential synergies are within a potential acquisition, as well as be highly involved in the actual integration of those companies, something that's hugely valuable that can bring a lot of shareholder wealth, and the finance organization has a key issue in there. Talked about investment analysis, capital management. Again, if you're in a capital-intensive industry, that's a huge issue. And then decision support and analytical insight. So this really ties back to, and we'll talk more about this with skills and competencies when we talk about training the finance professional. But if you talk to operations managers, they really, really want finance guys and gals who can help them understand the impact of their decisions. If I take this equipment offline for 3 days, what's the financial impact? If we order this piece or the lead time doesn't come in and we miss this turnaround, you know, what happens then? So finance really is being called to help operations managers. Key issues, whether you're manufacturing, chemicals, utilities, a number of other industries. So this actually, and I wish I'd put the book up, so a couple guys from CSC years ago wrote a book called The Disciplines of Market Leaders. And they said, you know, if you're a high-performing company, you know, what is your strategy? How do you clarify what you're doing, and how does that bring value to the organization? And what they came out with, and there's different models, right? So this is a model, but I think it's a useful model, is, you know, what's our strategy? So if you look at, in this model, this discipline of market leaders, what they found out is they excel at one, and they're at parity with the other two branches of this triangle, where, you know, you can be a product leader, and, you know, Apple's a great example, right? They created whole markets within smartphones, within tablets, within you know, online digitally distributed music, right? Creating clearly a product innovation type company. And I hate the fact that these are all U.S. examples, so I do apologize for that. Customer intimacy. So Nordstrom's is, and you probably don't know this, but it's a retailer. It's a very high-end retailer in the United States. It's one of these things that, I mean, it's absurd, you know, what they charge for their products, but people pay it. Why? Because when you walk in, they know your name, they know what you like, they know your shoe size, your dress size, your suit size. They know everything about you. It's kind of scary, right? But they get high marks for customer intimacy, and it's a reason why people pay a lot of money. And then operational excellence. That's the one most people are familiar with as a model. Have UPS there. It could be Walmart. You've got organizations here in New Zealand who they're known as, you know, the highly efficient supply chain, the low-cost leader. A lot of them are in retail. So you know, there's that model. So again, the idea behind this theory is that you excel in one and you're at parity with the other two. The strategy that a company chooses will obviously impact the finance organization in terms of what are the skills and competencies you develop, how many people you have in each area. Do you focus on creating the leanest, meanest organization, finance organization you can? Or do you have resources in areas like customer profitability, you know, customer knowledge, product profitability, those types of things that can help you make decisions about those, you know, those issues as you go along. So that's kind of the idea of aligning the finance strategy with the corporate strategy. Again, there are different strategy models. Your company may employ a different one. But I encourage you to think through this issue in terms of, if this is our corporate strategy, are we really, as a finance organization, working to support that strategy and provide them the resources they need? Okay, I'm going to go through a couple of these slides fairly quickly. Again, you'll have them. So again, this is really about strategy development. There are literally entire books that have been written on strategy development. But a couple points I just want to make, and it may seem self-evident, but it's amazing how many times you have a grandiose strategy that can't be implemented, but it needs to be actionable. It needs to be concrete enough in terms of a finance strategy, in terms of where you're going to put resources, what skills you're going to develop, what competencies you're going to hold internally, what ones you're going to outsource. So it totally plays into that. It needs to be flexible enough. We talked about business agility this morning in my opening comments, that organizations, because of the GFC, the cost structures, they're really looking at how do we create an agile organization that can quickly respond to market demands. And then clearly scalable, whether it's your strategy around the people, the processes, the technology. You need to be able to build, especially as we come out of the global financial crisis. Smart organizations and leading organizations are looking at how can we position ourselves for growth in the future. So I was asked the other day, isn't lean finance just about cutting heads? No, it's not just about that. It's really about being smart about how you invest your resources so you can redeploy them to higher value activities. And that's what leading organizations are doing. And it's supportable and measurable. You need to be able to define, and this gets back to the whole idea of a balanced scorecard, the metrics. I told you I have clients who've got, they probably have over 100 metrics when they should have 12, right, in terms of enterprise level metrics that really help them manage their business. You got to be able to measure, is your strategy right? Are we supporting the business in terms of customer intimacy or operational excellence? What are our goals and how do we measure that? Okay, we've talked about a lot of this, but we talked about maximize efficiency in transactional processes. We're going to talk more about that in re-engineering the function. But we talked about things. How do leading companies do that? It's the things we talked about: integrated technology, good governance, complexity reduction, having the right delivery model, and then organized centers of excellence. So within shared services, and you may hear more about this tomorrow, both in the morning talk and certainly in my discussions in the afternoon. There's this idea that there's certain transactions that are, benefit from scale and volume, things like accounts payable invoicing. And then there are the other types of activities that benefit from knowledge, so more of a knowledge-oriented, whether it's business intelligence. Sometimes areas outside of finance, like HR, fit into this area, is how do you organize some of those knowledge areas? But that's true in finance, too, whether it's treasury management, tax management, those types of things, is how do you organize those? What leading companies are doing is really pooling them into centers of excellence so that they develop that knowledge base within specific areas, and then they share it to all their operating business units. We talked about business intelligence. So here's another thing, reducing reliance on the annual budget. So one of the characteristics of leading organizations is they're not spending so much time budgeting, because typically what happens is months and months of work go into the budget, and then January 2nd comes around, and it's like, oh, you know what? Our budget's not applicable anymore because the market conditions have changed, right? Leading organizations are figuring that out. And it doesn't mean they're doing away with budgeting, although there's a movement to get beyond budgeting. Maybe you've heard about the Beyond Budgeting Roundtable. I think it's out of the UK. But what they're basically doing is scaling down the budget and depending more on the forecast. So you think about it. We live in a dynamic global environment. Opportunities come and go. Conditions change quickly. We want to have good business agility. It makes a lot more sense to allocate resources and capital based on your best forecast than on a budget that you did 6 months ago. So that's the thinking behind that. Foster an environment of continuous learning improvement. We heard about that this morning. So critical, not easily done, but it's so important. And then benchmarking regularly. We're going to talk a lot about benchmarking after the break, so I'll wait on that. And then basically customer-facing characteristics of world-class finance organizations. So if you think about the model where finance is its own business, right, and it's actually providing services, and I firmly believe that, because we talked about third-party outsourcers. Really, the way to think about it is every activity you perform in finance, you need to think about the fact that you're competing against other people, not just the guy in the next cube or the guy down the street. You're competing against that outsourcer on the other side of the world. And honestly, if they're doing it more efficiently than you are internally, right, and it makes sense from a scale and a governance and kind of a strategic direction perspective, you need to be thinking about, why would we keep it in-house, right? But that's not to say you should ship it out. It's to say that we're competing against them. We need to be even better. So that's part of the continuous improvement effort. To have a value business partner, ability to change the market agility issue, streamline processes. So these are things that you think about from a customer perspective. And, in my talk, I won't get into service level agreements, but fundamentally, if you're a business offering services, You need to think about what are the metrics we measure ourselves by, how do we measure customer satisfaction, how do we deliver that value to the organizations. So those are some of the characteristics. I know we're going through this quickly, but I do want to get to the case study. And here it is. It's only a couple slides, so we'll finish up in the next 5 to 7 minutes. Many of you have probably heard of Unilever. It's a consumer products company, global. There are over 400 brands. They're in 180 countries, which is pretty amazing because I think the United Nations recognizes like 192, right? Varies from day to day, but it's somewhere in that number. So fundamentally, I don't know what the 12 countries they're not in. Maybe Afghanistan's one of them. But they're basically a huge global brand. 2 billion consumers rather. Interesting, 53%, over half of their sales worldwide are in emerging markets. That's pretty astonishing, but it shows the power of globalization, what's going on in places like China or Brazil or India or elsewhere. So huge, huge potential. Another great reason from a globalization perspective is not only is talent sourcing, maybe more cost effective, but you're actually servicing people within those markets. So years ago, not that many, a couple years ago, Unilever went through this finance transformation type activity and thought about, what do we want to be when we grow up, quote unquote. Remember, global company, 180 countries. And they basically broke it down to 5 things. You can see them up there. World-class finance processes, a lot of what we talked about earlier today. Deep integration, end-to-end, supported by technology, with good internal controls, minimum cost structure. Innovative business partnering, right? So again, the value of lean is it gives you choices about how you want to reinvest your capital, how you get to partner with the business. If you're in the fourth quartile company we saw earlier, and you're spending 60% of your FTEs on transaction processing, you don't get to do the business partnering as well as you'd like to, right? So that's the value of lean thinking. Financial flexibility. We talked about the whole cost structure. How do they support multiple markets? How do they respond to a dynamic environment? And then performance management. So this really encompasses a number of things, but some of the key issues are, from a high-level enterprise perspective, what are the dozen top metrics that we want to measure our company? How do we cascade those down through layers of the organization? And ultimately, how do we embed those metrics in people's annual performance expectations so that when they walk in every day, they understand what they're doing, how they're aligned, what the vision is, and how what they're doing impacts that, and then ultimately how they get graded, right? So a lot of things go into performance management. And then people and organization, right? So Unilever was committed to, when they looked out into the future and created a vision of what they wanted their finance organization to be, they saw some skills gaps, and they basically said, we're going to develop the people and competencies so we can close that gap and realize our vision and our strategy. So here's 3 pillars of finance strategy. And this was Unilever's model. But I'd say, based on it as a consultant, this is a very logical grouping of activities. You may even have it in your company today. So one of the things they did is they focused around accounting and information, basically a lot of transaction processing, those things that actually focused on benefiting from economies of scale, from standardization, from automation. Then they talked about expert services. Those are the ones that talk about centers of excellence on the previous slide. It's how do you group that knowledge together for those expert services that are not necessarily about economies of scale or about low unit cost, but it's about the knowledge pools and how you can effectively service your organization. And then the third one was the business partnering aspect is for their various business units, right? It's how do we help them make the right decisions, things I talked about earlier. What's the impact of this pricing decision or this cost structure? Or if we increase the volume, what does that do to our unit costs? It's that type of business partnering information that makes the finance a valued business partner with operations. So here's kind of a transformation journey. So fundamentally what they did is, the nutshell of the summary of this slide is they had all these different business units. They all had their own finance organization. They all did their own thing. And everybody was happy. Well, except for the investors who were spending a lot more money on finance services than they needed to. So what they did is they basically, each finance organization reported up to the CEO of that business unit. They were viewed as bean counters. And this is from a lot of Unilever's own presentations. That's not my personal take. But we understand where they're coming from because we've been there ourselves many times. They had over 9,000 FTEs globally in their finance organization, right? Unilever is a big company, but that's still a lot of FTEs. And then transaction processing was decentralized, right? So once you learn that, it's like, oh, well, now I understand why they had a lot of FTEs, because each one had a self-contained finance organization. Makes sense. Doesn't make sense that they did it. It makes sense why they had a lot of FTEs. So they went through a transformation journey, and their effect was they had one global finance function where fundamentally the finance resources served the business units, right? But they're reported up through the finance organization. I personally believe that's a better model because it still enables you to service the companies and the business units. But I think in many ways it provides a better career path, a better culture, a sense of you're part of a global finance organization as opposed to you're part of this business unit. And in a company like Unilever, business units can vary from gigantic to relatively small. So if you're in one of the smaller ones, you feel like maybe you're cut off. So I think from a career perspective and a culture perspective, it's a much better model. They focus on creating value with their business partners. They reduced it from 9,000 to 5,500 FTEs, pretty substantial reduction. They focus on decision support, something we talked about, the value of information as a strategic asset. And then they deploy both shared services and outsourcing as a model. So what they fundamentally did is what we're going to talk about in depth more in the other sessions, is going through the value chain, these integrated processes, and looking at each step in the value chain and saying, does it make sense to do this in the business unit? Does it make sense to do it at corporate? Does it make sense to do it in shared services? Or should we outsource it to a third-party partner, right? Someone who's not just transacting, but they're actually working with us on making the process more efficient, maybe even conveying and disseminating knowledge back into the organization. So that's basically the Unilever. I know it's fairly quick, but I wanted to get through that. But it shows the power of lean finance thinking, of creating an organizational structure that's aligned with the strategy and the vision of the corporation, that uses technology efficiently, that has good, strong governance over data and processes and organization, that treats information and data as strategic assets, that provides a strong planning and performance management function, and fundamentally moves the organization from a transaction processor, bean counter, controller type mentality to one that does those things effectively, manages enterprise risk, and yet enables the company to spend more time actually partnering with the business and adding the value to both the operations group and ultimately to shareholder value. So that's the overview of the value-adding organization.